Hello, today is January 18th, 2020. Let's go over our calls. Look for the pattern with the early high Friday. That's it. We said the rally wasn't over and we got higher prices. We're quite extended here. I don't use to mark stuff much anymore, but any price over Friday's close will be bar number 13, the final one of a sequential sell signal. We're also printing a bar completely over the upper Bollinger Band. You don't usually get huge rallies from that point. Doesn't mean you have to collapse. It happened here and you consolidated a while, but it's not the kind of position where I look for the rally to continue. Now with any conviction. We also have 3 bars straight with a monthly bar over the upper band that's really about as overextended as you're going to get. Again, doesn't mean you have to collapse. During the day, it said ultimately higher price would print, which they did. The afternoon, MEJT said both higher and lower price would print. All this squiggle satisfied both of those targets. This is what I said Thursday night. We still have a possibility of a blow-off top into the 3460s. But as I've said, it doesn't mean you have to go there in a straight line. It doesn't mean that you won't have some consolidation first or even some correction first. These are the patterns I'm looking for next week. Now, I'm looking for wave grade 3 to be at least equal to wave gray 1. And if that's true, you should hit the 3460s before we're done. Doesn't mean you won't have stops along the way. And to find the stops, you look for fib targets of wave 1. Next one I have is around 33.52. We're pretty close to there now. This is also a Gann number. You like to divide things into thirds or eighths. If you take 10,000, divide it by 3, that's what you get. You will recall if the low was 666. You take 2/3 of 1,000, and there it is. So that's numbers he likes. You get pretty much the same number as a Fibonacci target of the prior consolidation. You take this low and this high, set it to 61.8%. You get 33.3413. So we have resistance in the 33 plus 33.34 area. Resistance doesn't have to hold, but we're pretty extended, and I think it's going to be pretty hard to get past that price right at the moment. Now, Tuesday's pattern has the early low. Prices are down in futures. It doesn't mean they'll open down, but it's still possible to gap up. A rally all day Friday typically carries through to the next day's open. Gapping down smartly instead is negative, should lead to further declines. If it's reversed promptly, the gap doesn't count. If it occurs, if we gap down, most likely things recover, typically in a day or so, then find resistance over Friday's high, and that's the level where I expect to find resistance. Sentiment readings are at such an extreme we should get some sort of correction, but it could be a correction in time instead of in price. Again, prices over the upper Bollinger Band suggest correction, but the breadth levels, new high levels, just aren't compatible with a collapse. Now, about a week ago, I said I didn't like to recommend specific trades, but I thought if there was ever a time to get a straddle, that was it. Anyone who bought a straddle a week ago made some good money. I now think if there's ever a time to ratio right put options, this is it. But again, if you're not familiar with options, don't risk your money. Let's take an example of how this works. It's not a specific trade I recommend, just an example. Again, if you're not familiar with options, don't risk your money. And this is an example of a trade, not one I'm recommending. Also, a ratio right is more profitable in declining markets because the time premium on the out of the money puts offers greater opportunities. Well, the SPY closed around 332. Suppose, as an example, you wrote a 328, 323 ratio right. If you bought one contract at 186 and you sold two at 107, which is 214, they'd pay you 28. And if you kept this until expiration, which I'm not recommending, and we didn't close under 323, you make 0.28, which is $28. Now, if prices and volatility aren't changed in a week, you can look at where the options are 2 weeks out instead of 3 weeks out and kind of estimate what these things would go for. This would drop from the 180s, would drop about 80 cents, and this one would drop over 50. You could then sell the 380, purchase two of the 323s. It would actually pay you 3 cents, and you make 31. You can make 0.31 on the trade. You can do the same experiment. You go out a week, see what happens. If you're 5 points higher, you make about 24 on the trade, 0.24. If we're 5 points lower, you make about 0.89. So if you stay within 5 points on the SPY or 50 points on the SPX, which certainly isn't a guarantee, you make money. And you can't annualize the returns because it's inevitable that the premiums based on volatility will change throughout the year. At least for a week, it's roughly twice the return you can get from a certificate of deposit. Of course, that's a riskless investment, and option trading isn't. Now, if prices rise, you keep $28. I don't recommend holding to maturity, but at least you're not going to get hurt. Suppose they drop. If they drop, at expiration, you make $5 on the 328, 323 put spread. You'd be forced to buy SPY at 323. They paid you 107, so you're actually forced to pay 321.93, but you got 528 in your pocket. So at expiration, you're only in the red if prices are under 316.65 in 3 weeks, which is about don't forget they're at 332 now, so you're talking 15 points. That's a lot. If it's exactly at 323, you make $528 per spread. So this isn't a get-rich-quick strategy. It's a get-rich-slowly strategy. But the worst that happens is you purchase the SPY at a price well under where it trades now, and that's the worst that can happen to you. Anything else, you're going to make money. Now, because of slippage and fees, you're probably going to make a bit less than that. If you make a trade in an IRA, you're going to be required to keep enough money in cash to pay for an exercise. You won't be able to use that money for investing elsewhere. But this is a strategy that people familiar with options could certainly consider. And if my call is right, that we're going to not have a huge rally, but we're going to drop some, probably from not much higher than where we are now, but not collapse. You can have a low-risk trade. So, when the market reopens on Tuesday, looking for the pattern with the early low, we have strong resistance just a few points over Friday's close, and in spite of all the overextendedness of the market, and in spite of the fact I don't think we're going to race ahead in the next week or two, I don't think the rally's over, and I still have higher targets, and that's today's call.